The challenge is that most portfolios are still built for a world where these dynamics are ignored. Understanding the code is only useful if you can act on it. The next step is to rethink how you allocate your assets in a system where the old rules no longer apply. Most portfolios are still structured for a world where debt was low, demographics were supportive, and central banks played a background role. The classic 60-40 split between stocks and bonds worked in that environment, but it's mismatched to a system now shaped by the everything code. Recent studies show that balanced portfolios have struggled to keep up with inflation since 2020, largely because they ignore the new forces at work. To adapt, investors need to make three key shifts. The first shift is to move away from holding large amounts of cash and instead focus on assets that resist financial repression. In a high-debt system, cash consistently loses value as policy aims to shrink debt burdens through inflation. Treasury inflation-protected securities, or TIPS, offer a way to maintain purchasing power, with 2-year TIPS currently yielding around 2% above inflation. For those willing to take on more risk, short-duration corporate bonds from companies positioned to benefit from AI adoption provide another alternative. Commodity producers tied to real economic trends, such as copper miners supplying AI infrastructure, can also help offset cash erosion. The goal is to hold assets with intrinsic value that can adjust to shifts in the economic environment, rather than relying on nominal currency.